Hi, everyone. It's Mike Maloney and Alan Hibbard again, and gold is soaring. What do you have, Alan?
Yeah, absolutely. I mean, gold is just it's up over $100 today. We're over 3340. And I got a couple things here I just wanted to bring to everyone's attention. So yeah, like I said, up over $100. Also, a recent article, the major investment banks are all increasing their forecast for gold pretty
Which
significantly.
which we knew was going to happen. I mean,
Yes, and
this
keep in mind, they always underestimate. They always underestimate. They're always wrong. Gold moves way faster than they think, and they constantly up their forecast.
yeah, after it hit their target, they
Yeah,
make a target. Next week it hits it, and the next week they increase it.
yeah, yeah. It's maybe not weekly, but like what they think happens in 12 months sometimes happens in like 2 months or
Exactly.
three. So
I'm exaggerating. So,
these
yeah.
yeah these revisions happen all the time. So gold is uniquely positioned to hedge recession risk. That's how Goldman Sachs Commodity Research Group concludes their note, upgrading their year-end gold price forecast to $3,700 with an upside tail risk scenario of 4,500 per ounce. So pretty substantial increase, Mike.
Yeah, I think it can actually go quite a bit beyond that. I think that we are up for some immense changes this year. I'll have another video coming out. I think it'll probably be the one that follows this one, and everybody's going to want to watch that because of all the little breadcrumbs that have been dropped by the government and the Federal Reserve, Secretary of the Treasury, and the president that sort of lead up to a really big event happening. And so I'm going to be cutting that video sometime very soon.
I'm guessing it has to do with a new monetary system.
Uh, yes, right. And Mason says, is this the right time to buy silver? As I've said many times before, I never give advice. I only tell people what I'm doing. And with the gold silver ratio over 100, I believe that you did a study recently. There's only been, 11 weeks in the last 2,500 years that this opportunity of silver being this undervalued or more has existed, right?
Yeah, I actually just updated it this morning.
Yep.
I've got a list of the top 30 because that's what fit nicely in an image here. The top 30 gold silver ratios per week. And so these ones in yellow are the three most recent weeks, including the week we're in, which hasn't ended yet. But if it ended right now, today, these 3 weeks in yellow would be in the top 15 all time. And you can see if you just look at the last two digits of all these dates, these are all in 2020. So there was a period of 10 weeks in a row. They're out of order, of course, but there was 10 weeks in a row where the gold silver ratio was well over 100, up to 118. And we're in that territory now. So this
That
is like
was that
record.
was the COVID panic, and I don't recall what was going on as far as like margin call and stuff like that. But silver took a big dip, and gold didn't go along for the ride, and so that spiked. And I was able to accumulate. I didn't hit that 118 or 120, but I did accumulate more silver, like in the 110 range, over 100.
Yeah,
So
that's
I may be uh, buying myself or even changing some gold into silver.
Hmm. Well, that's still pretty fantastic because I mean, when we zoom out here and look at the gold silver ratio historically, the axis on the right side, you know, in this time period, the last half century, it's around hovers around 60. So if you're getting it up around 100 or 120, that's incredible. That seems like a great deal to me.
Yes, absolutely. And then when you look at the really long term, you look at 300 years of the silver price or greater. Uh, so, uh, so Carbon 239 says silver is the wild card bet. Yes, it is. Dan, what was the message before this one? You put up a message that we didn't read. Um, I'm looking up on silver, buying more today. Excellent. Well, I don't want to. like encourage anybody. Because there is a possibility, but it's a remote possibility, I believe, that silver could go over the ratio could go over this. So silver become more undervalued, and it could stay there for a while based on whatever the central banks do with gold. However, it looks to me like we are going into a economic slowdown globally, and because silver, that most of the supply comes from mining base metals. It's a byproduct. It's not a primary production, and just when everybody wants it, uh, when there's monetary demand, that's what makes silver spike. So Thomas Kennedy, you read this one, Alan.
This is bananas. I regret not buying more over the past few years. Presumably he means gold. Oh well, chin up and keep stacking, I guess. We are in for one hell of a ride.
Yes, well, I believe that you can catch up to whatever move that you missed in gold with silver. That's my message, and I believe that's been yours as well for quite a while now, Alan, right?
Yeah, you just have to be patient. I mean, you don't know how long these things are going to take to revert. And so if you're willing to wait an unknown amount of time, then presumably you'll be able to catch up in any asset relative to any other asset.
Which I have done. I've been waiting for an unknown amount of time, but it sure does feel like the message that David Morgan used to always say is that 80% of the move comes in the last 20% of the time, and it feels like we are there right now.
Yes.
I still believe that gold can move multiples from where it is, and that silver will move multiples compared to gold.
Yes. Yes, I agree too. I updated our gold bull market chart relative to the 1970s today
Oh,
versus
you
the
did?
1970s. Yeah, with yesterday's closing price of 32.37. And when I add it like a week or two, you barely notice it. It's like hardly a pixel. So what that means is, we're still on track and there's still a huge increase still to go. I mean, there could easily be another tripling in the next 2 years. I mean, there's so much room to go up here. We're absolutely not done.
Yeah, right. Okay.
So very exciting. And one other thing on the
Let's explain that chart to the audience real quick.
Sure, yeah, for anyone who hasn't seen it. Well, we're basically comparing two different bull markets in gold. So the first one in blue, okay, has the dates across the bottom and the price on the left side. And you'll notice that it's a logarithmic chart on the left. So when you go from the bottom to the halfway point, it multiplies by 5. And then when you go from the midway point to the top, it multiplies by 5 again. So instead of adding the same amount, we multiply. You can think of it as the same percentage return. And in the 1970s, gold had this amazing bull run where the price of gold went up approximately 25x, right? 5 times 5. The bull market we're in now, in red, started around August of 1999, I believe.
Mm-hmm. That was
depending which day you want to start it, around 1999, and it's been 26 years, and it's looking like we have another year or two left, and it's followed a very, very similar trajectory to the bull market of the 1970s. And these are basically the two bull markets that we've had in gold since it was unpegged from the dollar. So it's not like we're just picking a random bull market that looks nice. These are the only two bull markets. So this is all the evidence we have to go on. And you can see the price here. It started around $250 back in 1999. It went up to $1,500, and it could go to $9,000 if this plays out in the next year or two.
What's each multiplication on that scale then?
Multiple of 6. So it's not a multiple of 5, it's a multiple of 6. So the bull run is actually larger than that of the 1970s. It's just taking more time to play out.
Yeah. And how did you line these up?
Basically, starting the beginning at the beginning, and then lining the peak of this first wave with the two bull markets, lining them up together. So
okay.
Yeah.
Okay, let's move on to the next thing you've got for me.
Yeah, just a day ago, I think it was, I saw this from Bank of America Global Research. They survey their global fund managers every month. And one of the questions, this was chart 18. They had dozens and dozens of charts. So one of them was, Which of the following do you expect to be the best performing asset class in 2025? And a record high percentage of them, 42%, said gold. And that's the dark blue here. So in the April survey, 42% said gold. If you look at previous months, March and February, the other two colors, it was like half that. So all of a sudden, there's a huge percentage increase in the number of fund managers globally who think that gold is going to be the best performing asset class.
It's very interesting that they don't. It's too bad that they don't include previous years here, because I'd like to know what they said this time last year, this time the year before, because if you look at the bull market of the 70s, nobody was recommending gold at the, when it was really performing. And there's this movie, Richard Pryor in Brewster's Millions, and John Candy is trying to get him to stop wasting. He's got to spend like $1 million in a month or something in order to be able to inherit another 30, but he can't tell anybody. And so he's been just wasting all of this currency. And John Candy is one of his friends. And he goes, oh, yeah, I've got this advisor that's got me into some collectibles and some art, some gold and silver. And that was released in like 1982, after the bull market was over. That's when everybody started recommending like 10, 20, or even more, half your portfolio in gold. The big professional firms are very conservative in their estimates, and they always seem to make this same mistake. They're not, I went all in on precious metals, the best performing asset class of this century, back in 2002, October 2002. And I've stuck with it. And boy, has it paid off well.
Yeah. There's this amazing psychology I've noticed in investing. Of course, nominally, everyone is trying to increase the value of their portfolio, of course. But an interesting psychology emerges when you have a choice between potentially making money or making currency, right? Making a profit versus being sort of ridiculed by your tribe. Okay, however you define that. And I've noticed there are so many investors, whether they're professionals or amateurs or whatever, when they're given a choice between an asset that has like everything going for it, but that would come at the cost of their reputation, they would be laughed at for owning it. Very, very high percentage of investors are not willing to own that better performing asset. They'd rather not be laughed at, be accepted by their peer group. And, that comes at the cost of their financial success. So there's a very interesting psychology at play. Of course, not everyone's the same, but it's just something I've noticed.
Excellent. Okay, so read this statement.
Colin Scarrett. So glad I found Mike and Hidden Secrets of Money years ago. What a learning experience. Yes.
I want to thank you, Colin. That's very kind of you. Thanks.
Yes, me too, Colin. That's why I'm here, because I found Mike and Hidden Secrets of Money. Completely changed my life for the better. So yeah, we have that in common. Awesome. Well, I have a couple of the things that we can talk about, Mike. I mean, well, first of all, continuing with this chart, there's some interesting things here. I find it just hard to believe, or just kind of shocking, that of these fund managers, they think after gold being the best performing asset this year, they think cash is going to be the next best. A better performing asset than government bonds, which is so strange to me, and better, of course, than equities or Bitcoin, which maybe isn't surprising in some years.
I think they're putting cash down there as stocks are going to be falling. So if you look at this from a wealth cycles perspective, that cash is going to go up in value compared to stocks and possibly real estate. I do believe that we're finally in for this bear market in the stock market that has been very overdue. I mean, it's what happened. Ben Bernanke with the crisis of 2008 just pushed us into these gigantic bubbles, and then Powell doubled down on it. And when it's artificial like that, it has to fall apart.
Yeah, exactly.
Yeah, so
I agree. And this is a huge
pressure says that gold silver ratio telling you economic collapse is starting.
Yeah.
What were you going to say?
I was going to say, yeah, if you look at the change here from the previous month, if you look at March, the medium blue bar here for equities, that was up at 40%. 40% of the managers thought that global equities would be the best performing asset. Now it's all of a sudden down to 11% just from last survey to this survey. So,
Wow.
that's, 75% of those managers have changed their mind, right?
These guys do not lead, they follow. That is the problem. They don't look at the fundamentals and project out into the future. Now, I look at the fundamentals and project out into the future, but that means that I can be wrong for several months or several years, but then I am ultimately proven right, because the fundamentals eventually, they just have to prove themselves out. When there's these giant imbalances, the free market always corrects them.
Exactly.
Yeah.
Exactly. Well, one of those imbalances, just pivoting slightly, I did want to talk about treasuries, because treasuries have been a safe haven, obviously, for a long time. But this article in Bloomberg from, I don't know, yesterday or the day before, maybe, treasuries are suddenly trading like risky assets. Um, this represents a huge fundamental shift in like the underlying structure of the economy. So this is what you and I have been talking about, Mike, for a long time.
That is really big.
Yeah.
Yeah.
There's one AI takeaway here I actually want to read. U.S. Treasury bonds, traditionally seen as a safe haven, are losing their status as investors dump them along with stocks and other risky assets, causing yields to surge and the dollar to plunge. So capital is basically flowing out of everywhere. It's flowing out of stocks, it's out of treasuries, out of any other risky assets, out of crypto, including Bitcoin. It's flowing out of all these different places, and it's flowing into gold. So
Yeah.
that's so momentous.
People, until you read The Great Gold and Silver Rush of the 21st Century, and I believe it's chapter 7, where we're comparing the current bull market against the previous bull market of the 70s. And there are 18 times more. Right now, China is driving gold demand hugely. That is the retail investors in the United States. We showed a chart in the last one of these live streams that we did, where gold eagles and gold eagles, silver eagles, and the Perth Mint products have all been falling for like the past 2 years. The sales on those. This is a great indicator of retail sales and retail interest from the smaller investor. Also, I see it being a dealer. I see what's going on, and I talk with other dealers, and the public seems to be asleep on this, while it's whales that are taking a position, and then the public in China, where they are experiencing a big crash going on. That is what's causing the price to move forward right now, and it's a shame but you really need to read that there's 18 times more people that can legally buy or afford precious metals on the planet. There's, I believe it was 53 or 55 times more currency, and there's 200 times more millionaires, 220 times more billionaires, and so on and so forth. So it's something that where gold could go, you really can't wrap your mind around until you analyze all of the fundamentals underlying it. And these are the fundamental drivers of what is causing the price rise.
Yeah, absolutely. And when gold moves to the upside, it moves a lot quicker than other assets do, because it is a safe haven. So those jumps at the end are just breathtaking. It'll be exciting for me to live through one because I wasn't around in the 70s. Yeah. So I'm so excited to see what happens.
So picture 2628, wondering what percentage of metals Mike recommends to have in our portfolios. Again, I never recommend anything to anybody. I tell people what I do. I'm currently about 95% silver, and that's measured in dollars, not ounces. So it's even greater than that, measured in ounces. And the reason I am so heavily tilted towards silver is because I allow the gold-silver ratio to determine how much silver I buy or how much gold I buy. And when it's down, in the 60s, 70s, I buy a mix. And then when it gets up into the 80s, I buy very, very heavily tilted towards silver. And if it's over 90, I just don't buy any gold. And since I've been accumulating I don't accumulate as much recently because I've got a lot now. It took me 20 years to do it, but more than 20 years. But I do have a position where I feel very comfortable. And so I'm doing some other things like my farm and trying to change the world with permaculture farming techniques and other things like that. So I make no recommendations, but for me, silver it's a wild ride, and there are going to be times when gold takes off like a rocket and you go, oh my God, I made a bad choice. But you got to wait until the public comes rushing into gold. But gold seems too expensive. When people say, oh, back in the year 2000 it was just $250 an ounce, and now it's $5,000 an ounce. Well, wait a minute, how much is the silver? Silver hasn't moved as much. And that's what happened. That's exactly what happened in the late 70s. And silver just blew the doors off of gold when it came to the performance that you could get from it. So, yeah.
Are you concerned, Mike? I'm going to ask you a question now. Are you concerned that the government might do something, these days or coming up, like what they did at the end of the 1970s bull run, like sell orders only on silver to try to suppress the price?
Well, they've already raised margin requirements by 25%, and that was huge, and that did crush the price down. Yes, but it stores more energy for later. And so you will think that you made the wrong choice. But for me, I think the free market winning is an inevitability. And yes, they will try all of these things. And what you're going to see is the price of silver decoupling, the physical decoupling from the spot price. It happened during the crash of 2008. Silver decoupled big time. When the price of silver was down below 9, was it like 8 something? Or maybe it was 9. So I can't remember exactly, but a friend of mine calls me and he goes, this dealer down the street from me is selling 100-ounce bars at $18 an ounce. And then I looked on eBay and Silver Eagles, everybody was asking 36. There were sales up in the 30s when silver was down in single digits. So 3 to 4 times spot price for physical when there's a rush. And so I expect that there will be some price discovery that happens for physical, completely separate from what is going on at the commodities exchanges and all the paper silver that's traded.
Yeah, wild times. And for someone like me living in a first world country, I've never experienced that really with any asset class where there's a divergence between, the official markets and then maybe physical markets. So that'll be something wild to live through.
Yeah.
Another comment here, Ryan Wasink. Thanks, guys. I started in 2009 after watching your videos. Yesterday, I just buried a massive pile of wealth. Don't dare keep it in my house anymore. Feels quite satisfactory.
Yeah.
Awesome.
Because I'm high profile, I keep very, very, very little personally. All of mine is at Brink's Security in an allocated account. And, we've got InstaVault I would investigate this also, Ryan. So burying some, that's just fine. You need a treasure map for your kids, basically. That's what I did. I took all of my passwords, all of my accounts, everything financial. I put it line by line in a Word doc, and then center justified. Cut several copies exactly in half, sealed them in envelopes that were given to attorneys and my heirs, and the two halves can't meet until after my will is read, basically. Then the two halves meet, and people can retrieve these. But when you're dealing with things like cryptos and precious metals, they are so private that they can be lost, and so you want to make sure that you're able to pass on the wealth that you just buried. So, and I would consider some sort of storage account because it is so liquid. When you are talking about burying it, when it comes time to sell and go into a different asset class, or you want to convert gold to silver or silver to gold, because there's going to be certain points on we don't know what the end game is for this. You may want to ride silver, and when the ratio is down to 20 or below, start converting to gold and get 5 times to 10 times more gold than you paid for. That might be the strategy. It all depends on what the dollar looks like. If the dollar looks like it's really in trouble, you don't want to be selling for dollars. Or we might be going directly from metals into cash flow real estate, or who knows what sector is going to be the most undervalued. It might be high dividend yield stocks that you want to go into, where there's cash flow that comes out of it. But you probably want some sort of more liquid account. And the thing is, when you've got these allocated accounts at gold silver, it's not at gold silver, it's at Brinks. All we do is sort of manage the billing for them, and it's held in bailment. You are the only owner, and you can lock in a price immediately and have the cash in your bank account as quickly as a stock, basically, or you can convert from one metal to another. There is a spread on everything. And if you want to convert from like InstaVault to a physical product like Silver Eagles or Gold Eagles, there's an upcharge because one of them is ounces within kilobars of gold or 1,000-ounce bars of silver, which is the cheapest form that you can possibly buy. If you want to move into a more expensive form, then you've got to pay the difference of what it costs us, basically. So, yeah. Okay.
Makes sense. Yeah, I want to pivot a little. I've got another bit of breaking news here, another article that's pretty significant because it doesn't happen very often. There's another U.S. debt downgrade warning. So,
whoa.
Yeah, so this is from yesterday, talking about a report from the day before. In an April 14th report, S&P Global Ratings hinted that it could lower the U.S. credit rating, currently at AA+, by another notch if any of a number of things happen to make the U.S.'s fiscal situation worse. And it's a good bet some of those things will happen. So right now, the U.S. credit rating, well, it used to be AAA. It used to be as good as it could be. And back in 2011, S&P downgraded it one notch, and now there's talk of downgrading it again. So when a country's credit rating is downgraded, that basically means there's some concern they might not be able to pay it back. They might not be able to honor those debt obligations. So this is absolutely huge, Mike.
Well, isn't this inevitable for every debt-based fiat currency system? Yes. I mean, this is just the mechanics of it. It is the math behind a debt-based currency system where there's interest due on dollars that were created, but the dollars to pay the interest do not exist yet. This is part of the national debt and everything else. We can't stop issuing dollars, or we go into a deflationary collapse.
Yes, and it happens gradually, then suddenly, right? When Ernest Hemingway was asked, how did you go bankrupt? He said 2 ways, gradually, then suddenly. So it's a slow decline for a while. Maybe there's a credit downgrade, another credit downgrade, and then boom, it drops off a cliff. There's a big downgrade. This is just, like you said, Mike, it's math, it's inevitable. It happens to every fiat currency. And so we're just, seeing another nail in the dollar's coffin.
Okay.
Yes. And by the way, this, despite being breaking news, this is something that we've sort of been watching for a while. This is a chart from Tavi Costa, and it's almost a year old at this point. This is a chart that I showed in a video last summer. U.S. treasuries are now more volatile than gold. And this chart only goes back about 45 years. And it's basically the long-term treasuries total return minus the return on gold. So when this flips positive, gold is essentially a better bet than treasuries. It's more of a safe haven. And as Tavi points out here, it's the first time in 45 years. So this is a long-term trend. It didn't just happen out of nowhere, all of a sudden out of the blue. This is a long-term chronic thing that keeps building little by little by little. And if we could project this out, whatever's happened in the past 12 years, or I'm sorry, in the past 12 months or so, I could ask Tavi. I'm sure it'd be a lot higher now.
So this starts in 1980. Is that what it says at the beginning? Okay. So it's a shame that it doesn't go back to 71, because you would see a lot of blue before that deep red area. So
maybe we could ask Tavi, or I could replicate it myself.
Yeah.
But yeah, it's just another long-term trend here. And one other thing I wanted to point out here, and then maybe we could take some more questions. Or is there another question that just popped up, or no?
Yeah, it was, when is Mike going to have a live from Tom Adkins, have a live conference? I'm going to be at Rebel Capitalist Live, George Gammon's event. So you can see me there. That is coming up, I believe, in about a little over a month. So check it out, Rebel Capitalist Live.
Beautiful. Awesome. So yeah, one other thing I wanted to say here, this is sort of looking at how the stock market is doing. And this data is a week old. Okay. So anyways, today's close of 9.52% in the S&P matches the 8th best day in history, which might sound good. It might sound like the stock market was recovering, but take a look at these dates here. So these are the top 10 single days of the S&P. The last time it did exactly 9.52%, that was 1933. Okay.
So that's actually after the bottom of the 1920. The stock market bottomed in 32.
Yeah, and look at the top 4 dates here: 1933, 1929, 1931, 1932. Some big daily gains: 11, 12, 16%. But this is not like good company. this isn't where you want to be sitting.
And the other dates are 2008.
Yeah, 2008, global financial crisis, obviously the Great Depression, 2020, the COVID era. So, I mean, you could hang your hat on, oh, the S&P was up, almost 10% in a day. Maybe we've come out of it. Maybe we're going to avoid catastrophe. If you put it in perspective, it certainly doesn't look that way. It looks like we're in the midst of something very significant.
For our next live stream, can you put a counter argument to this and get the largest? Well, the largest down day is going to be the 87 crash, but a list of the top 10 down days, and see if we end up with a lot of clusters of the same dates, the same years.
Sure. Yeah.
Because whenever it falls a lot, there's high volatility. So the bounce is going to be high volatility. Right?
Exactly. Yes. Yeah. Yes, I agree.
Yeah.
Yeah. So those big days happen in crises for sure. So yeah. Oh, we got another question here. AOAB50. If BRICS countries agreed to use gold to settle their financial transactions, would the price of gold go much higher?
Yes, and you're going to have to. So AOAB50. You're going to need to watch my next video, because it's all about that and why I believe gold will be going up multiples from here. And it has to do with these proposals from the BRICS. This is part of it, but it's only a small part of it. There is a trail of breadcrumbs and dots to connect that really tell a story. And I've been working on that, putting together that video for a couple of days. Which international vaults are safe? Can you read I'm dyslexic, read the name.
Pino Kunchner.
Well, nobody has ever lost a penny with Brinks, I believe, since 1863. So you're talking about the Civil War. All of our accounts are at Brinks, but most of the major vaults are safe. And then if you're a whale, if somebody really goes deep, there are private vaults that you can buy where you actually own the whole vault in the mountains of Switzerland, because it was all tunneled for World War II and so on. But this is not easy to do, and it's not liquid. And you'd have to hire your own crew to guard it and everything. When you go with Brinks, it's insured. It's guarded with guys with guns. It's got the security on the vaults. It's top level security with seismic indicators to tell if somebody's trying to come through the roof or tunnel underneath it. It's super secure, and nobody has lost a penny. And so, yeah. Okay.
Mark, Cameroon, do you ever see gold coming back down to prices of 2,500 to 3,000 an ounce?
To me, that would take a pretty good deflationary crash for that to happen. But when you say 3,000 an ounce, yeah, we could retrace and bounce off of that. We're only 10% above that, so that one's easy. There's a big base that we built up at around 2,000, and then and I was saying we're in for a slingshot move, and boy, did we get it, and it continues. So it's possible, but to me, that would be another buying opportunity.
Yeah, exactly. I feel the same way.
Here's what you have to ask yourself, Mark. Are they ever going to stop creating dollars? That's what the question you just have to keep on asking yourself. Are they ever going to stop creating dollars? And what is the Federal Reserve and the government, the treasuries, what is the answer to every crisis? It is take rates down to zero and print, right? And we're in for a crisis. What do you think is going to happen next? And what do you think is going to happen to the gold price when they do that? Because we know the playbook now. We've seen it. It means the dilution. So, there may be another dip like we saw in 2008, where gold goes along for the ride when stocks fall and there's margin call for anybody that's leveraged, and they have to get liquid by dumping anything else that's on their platform, including precious metals. But you also have to look at things like how much of the world's population actually owns gold right now compared to where it was like in January of 1980. And it is a tiny, minuscule fraction. How many people own gold? What's the allocation of gold to stocks and treasuries and real estate and stuff? It is, it's gold has so far that it can run, and it's proving itself as a safe haven asset. And in the meantime, Basel III made it a tier one asset for central banks. Why is that? Why did they suddenly move gold into tier one position? So, yeah.
Sheridan Forbes asks or says, your most valuable assets are your time and freedom. This sounds like Hidden Secrets of Money. Your most valuable assets are your time and freedom. Be wise how you spend your time so you can enjoy more freedom in life. Stay away from paper assets. You have been warned.
Well, I believe now is the time for real stuff. The reason I bought farmland is farmland was still undervalued. Most commercial real estate and residential real estate, you have to find pockets and certain. But as far as the stock market goes, read my book. There's only one way that you can measure stocks that don't show them in the greatest bubble in history, and that is PE ratios. But even with PE ratios, it shows us in the third greatest bubble in history. In this rarefied air, where a sudden air pocket, some turbulence, can just cause a crash. And yes, I believe it is time to get real.
Yes. Water 27 Buffalo. Mike, do you still believe 500 ounces of silver will buy a median home in the USA?
Yeah, well, median homes are a moving target. A median home today is more square footage than you had like back in the 30s, for instance, if you look at examples throughout history, yes, 500 to 1,000 ounces. History doesn't always repeat, but it rhymes really well. So that's sort of a paraphrasing Mark Twain. And I say history always repeats, but with little twists. That's what creates the rhyme. But the fundamentals are there. All it takes is monetary demand. People rush it. When the crowd that wants to buy gold because something is happening to the dollar, then if people are worried about the dollar and they're rushing to gold, but gold seems too expensive, if it's 5,000, 8,000, 10,000, they're going to look at silver. So
Yeah, and just to do a little math here, let's pretend that the median home hits $500,000 an ounce, so
Mhm.
500K. 500 ounces of silver would mean that 1 ounce would have to be worth $1,000. So maybe if that happens some number of years in the future, that could be plausible.
Yeah. If you take a look, the chapter on silver, I can't remember what chapter it is, but you and I went through all of this, and we took the type of bubble that silver was in when it hit 52.50 in January of 1980, and we just projected what silver's price would have to be in balance with the growth of all of the other assets, stocks, bonds, the M2 currency supply, real estate, everything else. And just even the CP lie put it at $200. And I think it was the Wilshire 5000 put it at 3,000 something if it had grown as much as the Wilshire 5000. So you have to sort of be armed with all of this knowledge. And you and I spent 4 years studying all of this, Alan. It was really a super deep dive, and then confirming everything, making sure. Because here's the thing about writing a book: if you're wrong in a book, you are wrong forever. If you make a video or you put out a newsletter and you're wrong, it's gone the next week. And so we really had to verify, and we had Tim Burris working with us on verification and finding data sources for us. And so it was quite a team effort to do that.
Mhm.
Go ahead and read the next one here.
Error 151 asks, when will platinum catch up to the rest of the metals? After all, central banks are using it for coins.
No, mints are using it for coins. I don't know of a central bank that is using it for coins. I'm sorry to contradict, but some mints that are minting, even though it's a government mint, they're minting coins, and they're authorized to do so, like here by Congress. There are certain acts authorizing the gold and silver eagles and the platinum coins. But here's what I've said for many, many years, and I said it in my first book. Platinum, rhodium, palladium, they've never been money. They aren't money now, and they will never be money. And it's monetary demand. So I don't expect that platinum will ever catch up until we get to some new plateau with gold and silver. And then you have the economic lag of the economy catching up and balancing. They will go back into balance someday, if that's what you mean by catching up. But when you're trying to protect yourself and grow your wealth simultaneously, we are in a period of time right now, and I've said this many times, where the asset class that is the considered the safe haven asset, where you run to for safety, simultaneously becomes the asset class with the single potential biggest gains in absolute purchasing power. It's a rare moment in history. We had a few years in the 70s, and you had 1 year back in the 30s where this happens, where you rush toward gold and silver, and they protect your purchasing power. Not only protect it, but increase it. So it's an insurance policy and a capital gain play.
Yeah, win-win. But I agree with you on platinum and the other precious metals. They're not money. They're not money. So
right.
Yeah.
They're for catalytic converters. It's
That's right.
Basically industrial metals.
It's industrial metals. Rackler 1 says, I want to thank you, Uncle Mike, for educating us. Your video is life-changing for me and many others.
Well, when I started, I had red hair, and I look at some of the old pictures of me, and I looked really young because that was 20 years ago. And so, yes, now I can be Uncle Mike because I look like somebody's uncle now. Yeah. So, yes. But thank you very much. That's a great compliment.
Hayes T, you don't buy silver and gold to, quote, make money. It is money. You get it to pause inflation of your hard-earned assets.
Yeah, you get it to avoid the devaluation of fiat currency. That is the reason. To me, this is where you want to hold your wealth, something that is safe, that can't go to zero, and that doesn't have all, like right now, that chart of the volatility of U.S. Treasuries and the news that the U.S. could be downgraded again. This is all just part of the reason that you don't want to hold most of your wealth in cash. You want to be holding a lot of it in precious metals. It's got a 5,000-year history. It zigzags. Alan and I spent I don't know, a good 6 months or a year on something called wealth cycles, and we compared assets to different assets. When you do two assets, the stock market versus gold, the Dow gold ratio, you're taking the dollar out of the equation. How much of this stuff will purchase how much of that stuff? And what you see is that everything is trapped in this valuation range, and nothing actually goes up. Stuff goes up, down, up, down, up, down, up, down, and throughout time. And then there's something else that you're measuring it against going down, up, down, up, down, up, down. And so we are in this time period where fiat currencies, we're going to have a big change over the next 4 years. Something really big is happening. And I've written about it and predicted it in my books, and it's coming true. So, Hayes T. You don't buy silver to. Oh, okay.
That's the one we just read.
Yeah.
So yeah, I think we've made the point, Mike. Like gold is not only a defensive asset, but at this particular period in time, it's an offensive one as well, and it protects against inflation, against recession, against trade wars, hot wars, everything. So super attractive right now.
And for me, it has increased my wealth more rapidly than the other asset classes, with the exception of crypto. But when you start at zero, from 0 to 1 is an infinite return. So that's the first new asset class in I think it's like more than 600. Whenever bonds came out as an investment class, that was the last. I think that was like 600 years ago or something like that, or 400 years ago. And so cryptos are the first new one, and that's the reason that they've had the performance that they've had. We'll see where it goes from here. But the time-tested one is precious metals. So thank you so much, Alan, for bringing all this to us and being prepared. And I want to thank all the viewers out there. We'll see you next time.